Every country on Earth is in debt. The United States owes $38 trillion, Japan $9 trillion. The entire planet owes $315 trillion, 3 times the size of the global economy. But here's the paradox. If everyone owes money, who exactly gets paid, and how? When you trace the chain of borrowers and lenders, you discover something unsettling. The world doesn't owe money to anyone in particular. It owes it to itself. And you and I are the ones who pay. And that's not an accident. 4 men across 3 centuries each solved one problem. And the solutions to those 4 problems created a system we were never meant to escape, and where debt was never meant to be repaid. Let me show you what they built, and how. Let's start at the beginning. London, 1694. England was at war with France, and the treasury was empty. Tax revenue couldn't cover war costs. Traditional lenders refused King William III new loans because England had defaulted before. But the crown needed money. William Paterson, a Scottish merchant, had a solution. He proposed raising £1.2 million from wealthy merchants, roughly $300 million today. But here's what made it revolutionary. The loan would never be repaid. Instead, the government would pay 8% interest every year, forever. The mechanics were elegant. Merchants would deposit gold into a new created institution, the Bank of England. The bank would lend money to the government. The government would pay annual interest from tax revenue. The bank would pass those payments to investors. The principal would never be returned. The loan became permanent. For merchants, this was genius. A guaranteed income stream backed by Parliament's power to tax. As long as England existed, payments would flow. The banknotes they received could be traded like currency, but they were better, because they paid interest. Paterson's innovation was truly transformative. Government debt became the foundation of money creation. The Bank of England was built on a loan to the government. That debt was turned into bank capital, allowing the bank to issue notes and credit. For the first time, state promises became the engine of money itself. Parliament approved the scheme, because most of them didn't understand what they were voting on. And for the first time in history, national debt became a feature, not a failure. Within 50 years, every major European power copied the model. France, the Netherlands, Austria. By 1790, even the United States adopted it. Alexander Hamilton modeled the U.S. banking system on the Bank of England. Paterson died in 1719. But the system still stands. British government debt has never been paid off, only refinanced, expanded, and normalized. The battlefield became the balance sheet. By the early 1800s, Europe was consuming itself in the Napoleonic Wars. Every nation was borrowing. Every treasury was strained. The Rothschilds began as money changers in Frankfurt in the 1760s. But by 1800, Meyer Amschel Rothschild had positioned his 5 sons in London, Paris, Vienna, Naples, and Frankfurt, creating the first truly integrated international banking network of the modern era. In London, Nathan Rothschild realized something crucial. Paterson made debt permanent. But if government debt could be made liquid, tradable, and globally trusted, it would no longer be optional for nations. It would become structurally unavoidable. During the Napoleonic Wars, Nathan's innovation wasn't lending directly to government. He bought government bonds at a discount, then resold them to investors at a markup. He created the secondary market for sovereign debt. The government got immediate access to funds, and Rothschild pocketed the spread. Now anyone with capital could buy a piece of a nation's debt and collect interest. Government debt became tradable, liquid, and profitable across borders. At Waterloo in 1815, Nathan's courier network learned of Napoleon's defeat before London did. He manipulated the market by selling British bonds first, triggering panic, then buying at the bottom. When victory was announced the next day, bond prices surged. He made millions. But the true genius wasn't the profit. Rothschild realized that by connecting every bondholder across borders, he'd made sovereign debt too interconnected to fail. A default in one country would ripple through the entire financial system. From that moment, governments could no longer walk away from debts. Doing so would trigger chaos everywhere. By 1820, if a nation wanted to borrow, it went through the Rothschild network. They set the terms. Patterson made debt permanent. Rothschild made it universal. And no government could default without bringing the whole world down with it. By 1900, America was an industrial titan, but its financial system was fragile. Thousands of private banks issued their own currency. Money was local, inconsistent, and vulnerable to panic. Panic struck in 1907. Banks failed and markets collapsed. J.P. Morgan stepped in. At 70 years old, he gathered America's most powerful bankers in his private library, locked the doors, and refused to let them leave until they pledged their fortunes to stabilize the system. Morgan's money stopped the collapse, but Morgan knew he was too old to make this happen again. He was mortal, but his empire wasn't. So in 1910, 6 men boarded a private train to Jekyll Island, Georgia. Senator Nelson Aldrich and representatives from the biggest banks in America. They told reporters they were going duck hunting. For 9 days behind locked doors, they wrote the blueprint for the Federal Reserve System. The brilliance was the political camouflage. It had to be. The public was deeply suspicious of government-owned banks. Creating one would cause protests, so it wouldn't be called a central bank. It would be called a Federal Reserve. It wouldn't be owned by the government. It would be owned by private member banks. When the Federal Reserve Act passed quietly on December 23, 1913, most of Congress had left for Christmas, the United States government stepped back from direct money creation, handing day-to-day control to a centralized banking system. From that point on, new dollars entered the system as debt. The government issued bonds. Banks bought them. And the Federal Reserve created new money to absorb that debt when necessary. No gold backing, no savings constraint. The debt rolled forward, refinanced again and again. The machine didn't require repayment, only confidence. Morgan didn't invent the system, but he scaled it. Gold was no longer necessary, credit became the system. By the late 1970s, the machine was running hot. Vietnam War spending and oil crises drove inflation above 10%. The world was losing faith in the dollar. Paul Volcker became Federal Reserve Chairman in 1979. His solution was brutal. He raised interest rates to nearly 20%. Mortgages doubled overnight. Factories closed. Millions lost jobs. But inflation fell. The dollar was saved. Yet hidden beneath that sacrifice was a second effect. For 2 decades, developing nations had borrowed heavily in dollars. When Volcker's interest rate shock hit, those debts tripled overnight. Mexico owed $80 billion, Brazil $60 billion, Argentina $40 billion. The interest alone exceeded their export revenues. In August 1982, Mexico announced it couldn't make payments. If Mexico fell, American banks would lose billions. The entire Western banking system would crack. Volcker had a choice. Let the banks fail or save them. He chose the latter, and turned debt into a weapon of control through the International Monetary Fund. Through the IMF, the United States issued rescue loans, not to forgive debt, but to keep interest payments flowing to American and European banks. In return, borrowing nations were forced to obey strict conditions, cut public spending, privatize state industries, devalue currencies, open markets to foreign corporations. Economies shrank, unemployment soared, but the payments never stopped. This pattern has repeated for 40 years. Greece in 2010, Argentina in 2001, Sri Lanka in 2022. Every time, the same structure: IMF loans to keep paying interest, austerity imposed, sovereignty surrendered. Patterson made debt permanent, Rothschild made it global, Morgan made it infinite, and Volcker made it inescapable. 3 centuries after Patterson's experiment, here's how it works now. The U.S. government spends more than it collects in taxes every year. The Treasury issues bonds. Banks, institutions, and others buy them. When the Federal Reserve buys government bonds, it does so with newly created money. All those dollars flow into the economy. Citizens work and pay taxes. But those taxes don't just fund services. They flow back to service the debt. Billions in interest payments to bondholders. The circle is complete. Governments borrow. Central banks create money, citizens earn and pay taxes, taxes service the debt, and the debt keeps expanding. Global debt now exceeds $315 trillion, 3 times the size of the world economy. That sounds impossible. How can the world owe 3 times more than it makes? If you owed 3 times your income, creditors would foreclose, but sovereign debt doesn't work like household debt. The creditors aren't external lenders waiting to be repaid. They are internal to the financial system itself. Governments issue bonds, banks hold them as collateral. Pension funds hold them to pay retirees. Central banks buy them to stabilize currencies and markets. Countries lend to each other through reserves and institutions. The system owes itself. The debt flows in circles, from governments to investors, from investors back to governments, from one nation to another and back. It's not a pyramid, it's a web with everyone connected. And America's $38 trillion in debt? About 2/3 of U.S. federal debt is held domestically. Some of it is owed to government trust funds like Social Security. The rest is held by Americans through banks, pension funds, mutual funds, insurance companies, and the Federal Reserve. In other words, much of America's debt is America lending to itself. Another roughly $9 trillion sits in foreign hands. Japan, the UK, and China hold the most, around $2.6 trillion collectively. But here's the secret that Patterson understood in 1694. Modern governments don't plan to pay off their debt. Not now, not ever. This isn't a conspiracy, it's policy. They refinance forever, rolling old bonds into new ones. The principal never leaves. It just gets repackaged. If governments actually paid off their debt without replacing it, the financial system would contract violently. Government bonds aren't just IOUs. They're the safest asset banks, pensions, and markets rely on. Retiring them would drain liquidity, collapse collateral markets, and trigger deflation. So governments do the opposite. They don't eliminate debt. They roll it forward. Not recklessly, but rhythmically. In the modern system, debt isn't a temporary burden. It's the infrastructure, the steady pulse that keeps capital moving. The plan was never to repay it. The plan is to keep the world believing it will be paid. That's the real answer to who gets paid. Everyone holding bonds receives interest. But more importantly, the system itself gets paid. Through the continuous flow from workers to institutions, from taxpayers to bondholders. Patterson gave debt permanence in 1694. Rothschild gave it global reach in 1815. Morgan gave it infinite scale in 1913. And Volcker gave it enforcement in 1982. Together they built the economic architecture of the modern world. $315 trillion isn't a crisis. It's the engine running exactly as designed. And you and I, we're the ones who pay to keep it running. If you found this enlightening, subscribe. We publish fresh content weekly to help you understand commerce from a historical perspective and draw parallels to modern finance, and keep the momentum going. Watch The World's First Financial Bubble and Why History Keeps Repeating Itself. It's on the screen. Thanks for watching.